Welcome, and thank you for joining us today. My name is Ben Lethborg, partner of Pitcher Partners Melbourne firm and a member of our professional services industry group. 4 years after suspending their guidelines, the ATO has recently finalised its compliance approach to the allocation of professional firm profits, which is set to take effect from 1 July 2022. As we head into another phase of tax planning pre-30 June and budgeting and planning for the FY23 year ahead, we look forward to sharing with you today the ATO's new guidelines and how they may impact you or your practice. We're also pleased to have a representative from the ATO join us to provide some further and unique insights on the guidelines in this topic. Before I introduce the speakers, just a little bit of housekeeping for today. Please use the Q&A box for any questions you have during the webinar. We will endeavour to answer your questions during the session. However, if we cannot get to all the questions during the webinar, please feel free to contact any of today's presenters or your regular Pitcher Partners contact. A link to the slides and a recording of this webinar will also be sent out within around 3 business days. Now, let me introduce our speakers. Today, we have Leo Gusenfitter, Senior Manager, Tax Advisory from Pitcher Partners. Leo has a deep knowledge of the ATO's professional guidelines and their application to both practices and practitioners. We're also able to have Gavin Favell from the ATO, Client Engagement Director with the ATO, focusing on the private groups and high net wealth individual space of the market. In our session today, we'll be looking to cover the background to the ATO PCG and the preconditions and gateways for the guidelines as they apply. The transitional arrangements covered in the practical guidelines, various examples and impacts of the scoring system so you can take them away and understand how your position may be impacted. And we'll also start to look at some next steps for practices and practitioners moving forward. I'd now like to pass to Gavin Favell to start to get the ball rolling in relation to today's session and some of the detail and background of the guidelines, and we'll bring back for Q&A towards the end of the session.
Good afternoon, and thank you, Ben and Leo, for having me here today. Now, overall, the ATO acknowledges that it's very common for professionals who are practicing with others, such as lawyers and accountants, to use a variety of arrangements, whether they be company, trust, partnership, and at times those structures can be used in arrangements that some share of their income may be diverted to related parties, such as spouse and family trust for further distribution. Now, the concern that the ATO has in relation to this is that because they are professionals in relation to it, they are using their specialised skills and knowledge that they've gained in relation to providing those services, that it can result in inappropriate redirection and alienation of that income, so that the personal efforts and skills are not being appropriately remunerated. This has been a long-held concern of the office, going back to the days of Everett cases back in 1970s. And so the ATO in 2015 issued out assessing the risk allocation of profits within professional firms guidelines in 2015. Now, we observed after those guidelines were issued a concern that they were being misunderstood or misinterpreted, and so they were withdrawn in December 17. And we'll come to those in just a minute, giving you an overview. Since that point in December 17, we have released a draft guidance last year, guidelines, in March 2021, which have now been finalised in today's PCG that we'll be discussing as PCG 2021/4, published on the 16th of December. So if we look at taking a step back and looking at the suspended guidelines. So for the 2015 up until the 2021 year, and actually the 2022 year, as we'll go in for some of the transitional arrangements, in order to be seen as low risk from the ATO's perspective, you need to satisfy one of 3 tests. You had to either return 50% of your entitlement to profit from the firm within your own hands, or else you had to have a 30% average tax rate, both in the IPP or individual professional practitioner, shortened to IPP for these purposes, either in the individual's hands and also in the individual and the associates collectively had to have that 30% average tax rate, or else you had to have a remuneration equal to the top employees within your firm. Now, we did have concerns regarding these guidelines that some members of the community were misunderstanding or misinterpreting these, going into transactions which, while maybe meeting one of these three tests, were doing so in a fairly uncommercial way, or else introducing fairly high risk features and areas of concern within their arrangements. Now, the ATO undertook under these suspended guidelines that if you satisfy one of these three tests, we would not conduct any further review or audit in relation to those arrangements. So even though we had areas which were of quite concern, the guidelines needed to be suspended in order for us to address those issues. And that's when we started a consultation, which comes to the PCG that we'll be discussing today. Now, a finalised guidelines is a practical compliance guide. Now, a PCG does differ from income tax ruling or a tax determination that you would see other things that that the ATO publishes. And a large difference is that a PCG is not intended to actually provide an interpretation of the tax laws. So we are not seeking to advise how Part 4A or any other area of the tax law is being interpreted in relation to this. The PCG's focus is looking at the risk that the ATO views, identifying to the market and to professionals what we see as being high risk and those arrangements we consider to be high risk, and also provide you an understanding of where the Commissioner will be devoting his compliance resources in terms of reviewing these risk areas. So we have two gateways. These are initial stages that you need to satisfy in order to have these risk assessment framework applying to you. If you don't satisfy those gateways, we do recommend that you do contact us to let us to help us understand why you don't, or if you don't qualify but you consider it to be of a lower risk. And then we come to three risk assessment factors, which provide you with a score and a risk zone, which we'll come to later in the presentation. Now, if you are rated as green or a low risk area as a result of the risk assessment factors, you can expect that the ATO will generally not allocate any compliance resources. So we won't be intending to conduct any audits or reviews apart from a simple situation of trying to identify what risk rating you ought to be and just confirming that in there. Now, there is a time frame in relation to all of this. As I said, the previous guidelines covered up until the 2021 year. So if we are looking at you were low risk under those old guidelines, you can continue and you don't breach the gateways, you can continue using the suspended guidelines for the 2022 year and also for the next 2 years. So these PCG applies from 1 July 2022. However, if you were rated as low risk, the guidelines will apply to you from 1 July 2024. So for the 2025 year, you'll be within it. Now, if you were seen as high risk under the old guidelines, the suspended guidelines, then the suspended guidelines will apply for the 2022 year. But from 1 July 2023, we'll be seeking to apply the PCG 2021/4, and they'll be from 1 July 2022. So you will need to be satisfying the three tests that we look at, or at least considering the three tests, as compared with the suspended guidelines, which was only you needed to satisfy one of those tests. And if you are a new professional practitioner, or you have a new arrangement being entered into after 1 July 2022, you will need to be applying the new PCG guidelines from 1 July 2022.
Thanks, Gavin, for that brief introduction, and good afternoon to everyone in attendance today. Now, we're going to get stuck into some more detail about the PCG. Well, let's just take a quick high-level look, and when touch on this very briefly, because Gavin's already given a decent summary, that the guidelines at high level have 2 gateways and a risk assessment framework. And if you're low risk, you're going to get confidence that ATO will generally only conduct minimal compliance activity, probably just to confirm that the self-assessed risk rating was done correctly. But let's just step back a bit and think about, well, who does the PCG or these guidelines actually apply to? What are the preconditions? So it broadly applies to professionals. Now, the concept of professional isn't defined exhaustively in the guidelines. There are examples listed, like your traditional professions like lawyers, accountants, medical professionals, engineers, and so on. There's also a reference to some codes, industry codes about, well, what are the key features of a professional? So there could be some that might not be 100% clear whether they're covered. And it's important to note that it covers those who provide professional services to clients, as well as those who provide purely, let's say, internal services to a professional firm itself. So this could, for example, be a CEO or managing partner who has a purely executive role within the firm, but might not actually do any billable work and might not be client-facing at all. But in either case, they're covered. And the PCG applies to an individual level rather than a firm level. So what other conditions do you need to satisfy? The IPP, the individual professional practitioner, that either personally or via their nominated entities, they have to have a legal or beneficial interest in the firm and be considered to be a full equity holder that has full ability to participate in profits and voting and participation in the management of the firm. And the firm must also be structured in a legally effective way and have no high risk features, so it passes the gateways. And key point, and I've seen it come up a few times, that it doesn't cover situations where the firm is generating personal services income or PSI. So for some small practices that might have few employees, you might have, let's say, 5 principals and 3 employees, the general rule of thumb might be that, well, that firm is deriving the personal services income of those 5 principal practitioners. It's not deriving income from a business structure. So if you find yourself in the personal services income or PSI space, these guidelines don't apply to you. You have to consider the PSI rules. So with that short overview, I'll hand back to Gavin to say a bit more about the first gateway, the commercial rationale.
As Leo said, in order to access the guidelines, there are 2 gateways. The first gateway is that you need to ensure that your arrangement has a genuine commercial rationale behind it. So it has to have a genuine commercial basis for the ways that it's structured in terms of your equity ownership within the firm, but also in terms of how profits are being distributed must also be sort of dealt with in a commercial basis. Within our PCG, we do have 2 paragraphs which outline a number of factors which we would consider as being non-commercial, or at least a lack of commercial situations, which looks at where there is overt complexity or steps within the arrangement which seem to serve little purpose apart from a tax benefit situation, or else the result of the arrangements are actually at odds with the stated commercial purpose. Or there may be situations where the arrangements result in very little risk being resulting from those ones where it would normally be expected. The ATO also sort of puts in at paragraph 46 some factors about looking at where we would see as genuine commercial basis for the profits being distributed, that it is actually flowing to that IPP that is being calculated and determined in relation to their actual outcomes of their exertion, and it's being distributed in substance. A key area is that ensuring your arrangements are also appropriately documented. Often there is the sort of situation or the discussion about whether or not an arrangement has been put in place for asset protection purposes. And that's a completely valid situation, but you do need to ensure that you can demonstrate how that asset protection is being achieved, and also documenting if within a firm there are different classes of owners, that there is a documentation area as to why that might be and why certain rights might be varied in certain circumstances. And that documentation and the legal form of it needs to be consistent with the actual economic substance of those arrangements as well.
So I'll just make a few quick comments about what we think some of the key commercial and I guess non-tax driven rationales or objectives that a firm may seek to achieve through a structure that helps to bolster up its position regarding the first gateway. So typically you'd want the structure of the firm to attract and retain key people, should be relatively easy to get in and out of, and it should provide distribution flexibility to the owners and achieve some level of income and asset protection. And so those are key objectives which the structure may achieve. But as Gavin mentioned, just make sure that the structure is actually, form matches the substance. Actually, it's not more complicated than necessary. It actually achieves the objectives, and things are done on commercial terms and appropriately documented. Now, just on the next slide, I want to highlight what I think is an interesting comment that's in the guidelines. And this is jumping ahead a bit as we were talking about the green zone and the traffic light scoring system, but it's useful to mention now. What it says is that despite being in a green zone, if you drift from one year to the other, say from deep in the green to maybe just on the edge of the green zone, the HO may still want to understand why this is happening and the commercial drivers behind this. So even though in the green zone you don't necessarily get a safe harbour, if the HO identifies some behaviour, they might seek to conduct some form of compliance activity to better understand what's going on. Now, some might say this is unfair to those who may have a history of paying, let's say, high amount of tax, but new practitioners come in could just go just in the green zone, just on the borderline, and they won't have that history working against them to indicate any drift. Now, Gavin, did you want to touch on this point and explain the HO's thinking behind this statement?
Sure. Look, the purpose of this sort of statement is saying that we want to make sure that you are looking at the commercial rationale for your arrangement throughout the life of it. You need to look at all of these PCG guidelines and gateways on an annual basis, and need to look at assessing your risk zone annually. So if there is a situation that you are changing and looking further at that paragraph, it's talking about a significant change, but a significant change around how you are deriving your profits or distributing those through, there needs to still be a proper commercial reason why that's happening. And obviously, if we see abnormalities or changes occurring, we may be asking questions just from that simple situation of, if there's a change, is there additional risk there? So ensuring that you have got your documentation in place, describing what has changed and why that has changed is always going to be important. Thanks, Leo. Now, on the basis that we are through Gateway 1, we look at then Gateway 2, which is high risk features. And as I mentioned at the start, a problem with the suspended guidelines was that some practitioners, and again, I am referring to some, what we were seeing is the majority of people under the suspended guidelines were seen as being low risk and were being appropriately sort of rated as low from that perspective. It is often that situation that we are looking at the outliers. But what we did see was that some arrangements being put in place in order to satisfy as low risk under one of the three tests under the suspended guidelines actually imported or possibly already had some fairly high risk features which the ATO had significant concerns around. So in terms of these, this PCG, if you do have one of these high risk features, you won't be able to access the guidelines. You will be seen as being high risk initially. However, if you do have one of these risks, but you don't believe it actually, or at least one of these features, but don't believe that actually results in something which would be high risk from the Commissioner's point of view, you can contact us. There is an email which will be shown at the end of it, and it is literally littered throughout the PCG of professionals pdts@ato.gov.au, which if you have concerns around your risk rating or a feature of your arrangement, you can always contact us to discuss. Now, looking at the high risk features we have listed, the first, albeit the last bullet point here, is an arrangement which is covered by a taxpayer alert. And obviously, we're not listing those in here. They are listed and linked through our PCG to the taxpayer alerts, which are current and issued out. But the issues which you do find particular concern are financing arrangements, which relate to non-arm's length transactions in relation to the equity investments, exploitation of the difference between accounting standards and tax law, which at times we have seen situations that is resulting in a loss or a very minimal taxable income compared with the accounting results. There being a profit difference isn't of a concern initially, or a timing difference isn't of initial concern, but when that's being manipulated, there is definitely concern from the office. Arrangements that differ from the Everett and Gallen cases, and multiple classes of shares and units being held by non-equity holders. Now, as Leo mentioned before, this PCG is directed towards those owners of the professional firms who are equity holders and equity owners. A large concern that we have had is these non-equity holders, where you are not participating in the full voting or management of the professional firm. Salaried partners or effectively employees or contractors who are being treated as if they are owners of the business, but without the rights and responsibilities which do come to it, and then they are seeking to alienate their income from their actual personal exertion off to other members of their family or of their personal groups. So those are some of those high risk features that we have identified within this PCG. As we do identify other risk areas, we will update the PCG. It is intended to be a living document that we can identify additional areas of risk and also update other areas within the PCG as well. So on the basis that we do satisfy both of these gateways, and again, if you don't satisfy one of those gateways, please contact us. We come to our scoring system. Now, what these three tests, which were referred to as benchmarks previously, are now referred to as risk assessment factors. And again, the difference between the suspended guidelines and the new guidelines are that these new guidelines require you to consider all three of these risk areas factors, rather than simply just one of them. Now, in terms of what you need to actually apply in terms of the calculation of your risk score, the first two risk assessment factors are required in all circumstances. The third risk assessment factor, which looks at a market value of the services that you're providing, the ATO does acknowledge that that can be quite difficult to identify accurately. And so if you are unable to determine a market value of it, you can simply use the first two from that perspective. So if we look at the three risk assessment factors themselves, and again, I'll just go through an overview of those, and I think Leo will step you through a bit more of the detail. The first factor is the proportion of profit entitlement from the whole of firm group returned in the hands of the IPP. of the individual professional practitioner. Now here we have a scoring method. So if you are over 50% of, or receiving over 50% of the income, your income entitlement of the firm and the whole firm group, you would be receiving a rating of 4 or lower. And like golf, a lower score is the better outcome. And the highlighted sections here of that 50 being greater than or equal to 50, giving a score of 4 versus the 50% under 5 and less than 50%, is a bit of a direction in terms of the previous guidelines, or the draft guidelines themselves, of a change that we made to make sure that if you have received 50% or above, that will give you a rating of 4. The second risk assessment factor is the total effective tax rate for income received from the firm by the IPP and their associated entities. So again, under the suspended guidelines, we were looking at a rate of 30% for both the individual and the associated entities. Here we're looking at one rate across the IPP and their associated entities. And again, the score for this situation, if you were to achieve, say, a 30% rate, that would give you a rating, a score of 3. And the third risk assessment factor is looking at remuneration returned in the hands of the IPP as a percentage of the commercial benchmark for the services provided to the firm. Now, this area is looking at this third risk assessment factor, looks at the functions that you are providing to the firm, and so that effort that you are putting into the firm's business, and looking at determining what is a market value of those functions that you're undertaking. Now, we recognise that it can be difficult to determine. We do list in the PCG some of the ways you may want to be looking at identifying that by looking at staff within your own firm or within others, or else looking at with an employment agent. And it may be taking one of those value or remuneration packages, possibly at a lower level, and then looking at the additional functions and services that the IPP provides, which they do not, and then assessing that to be what would be the relevant remuneration that you would be expecting to pay somebody else to do that role from that perspective. And here, if you then once you have gone through those ratings and looking at those scores, we come to our scoring system. And again, if we're looking simply at the first 2 risk assessment factors, if you have a score of less than 7, you would be seen as low risk. If it's 8, you would be amber, or 9 or above, you would be seen as a red risk zone, and then be considered as a potentially high risk. Now, if you are looking at the full 3 factors, a low risk would be requiring 10 or below. Amber would be 11 or 12, and a high risk area would be 13. Now, if we are looking at what this means for you, we've already mentioned that if you are seen as low risk in green, you can expect that we wouldn't be looking to review or audit your arrangements around the professional firm equity ownership. What we may be doing is contacting you to just confirm that status or understand what you see as your self-assessment situation. But after confirming that area, we would not be expecting it. There may be other areas that we are already separately looking at, Division 7A or 100A or other areas separate to that, which may touch on these areas. And so that will still continue if you were selected for review. But in terms of what the intention is around looking at your arrangement, would not be seeking to take further action in relation to it. Now, if you're in amber or red, this does not mean that we will be undertaking an audit on your arrangements or consider that Part 4A or any of the other anti-avoidance areas apply in the first instance. What we will be seeking to do is to understand why you are in that risk rating area understand your arrangement better and see what it is. Because I think as Leo and Ben may go through in some of our examples later, there could be timing situations that put you into a higher risk rating, or certain aspects of the calculation which puts you in, but really doesn't reflect that higher risk area around it. So what the ATO wants to do is understand both your arrangement and how it is being structured, understand your commercial drivers and that you don't have any high risk features, but then ensure that understand why there is these high risk sort of ratings coming out. One last point, just before Leo does sort of take over. If under the first risk assessment factor, you actually return 100% of the assessable income in your own hands, there obviously is going to be very little risk of any alienation being able to be occurring. And so you'll automatically be achieving that green risk rating if 100% of the firm entitlements are going to the individual. Thanks, Leo.
First risk assessment factor being the proportion of profit entitlement. We just want to note that it covers the firm as a whole, the whole firm group is what it's referred to. This could involve a main practice entity, which traditionally is a partnership. It could also involve a service trust or even a company, as well as any other entities that comprise the firm as a whole. Now, some might argue that profits flowing from entities such as service trusts may in no way represent income from personal exertion, that it's a return on assets or administrative services, and that this shouldn't need to find its way into the hands of the IPP at all. But while I think that argument has some merit, at least what the ATO approach does, it creates a level playing field between those firms who operate out of just a single standalone entity as compared to those that might split up their practice into 2 or more entities and extract some overall profit into something like a service trust. So in either case, whether you've got 1 entity, 2 entities, 5 entities that comprise the firm, you've got to look at the total collective firm profit that flows up to the IPP and their associates. And the other major point to note is that you look at other aspects, not just profit share. You look at salary and wages, super fringe benefits, and even other benefits as stated in the PCG. So you look at the total package. Now, you might note that things like super contributions and fringe benefits can't possibly end up being taxed in the hands of an individual. They're taxed at the employee level or at the fund level, even if those benefits are provided to the IPP personally. So the presence of these forms of remuneration may naturally lower the score you can get under that first factor. And that just might be something that could be taken into account, let's say if you do end up in an amber zone. Now, touching on the second factor, the effective tax rate. So we look at the total tax paid for the year by the IPP and his or her related entities as a collective. So we're not focused any more on the IPP than anyone else. You look across the board, how much tax was paid by all the relevant entities. So you get a proportion here, you get a percentage number, effective tax rate. And so you get a numerator over a denominator. Now the numerator here is the grade of 2 amounts. So you can pick a result that gives you the more favorable outcome, which we'll demonstrate in the case study. But essentially the left-hand side looks at total tax paid, assuming the professional income was the only income derived for the year, essentially assuming that the distribution starts at $1. Whereas the right-hand side looks at the marginal tax paid on the distribution by looking at actual tax paid for the year, less the tax that would be payable for the year if no firm profits were derived. So this provides a benefit for those who have other sources of income, as you might say you have $200,000 of other taxable income before the firm profit comes through. As an individual, you count each dollar as being taxed already at 45%. So you've already used up your lower tax rates through other income. So that's quite favorable to those who, I guess, have more wealth and more sources of income. Now, the right-hand side generally gives you a higher tax paid, but left-hand side is more relevant where there are losses, such as where you've got negatively geared property, as you can effectively ignore those losses and work out your tax paid under a hypothetical where they didn't exist. Now, for profits that are taxed in the hands of non-individuals, these probably don't matter. You probably get the same outcome as they pay flat rates of tax. So it's going to be either 25% or 30% if it's at a corporate, regardless of how much other taxable income they have, or even 45% if it's a trustee assessment, where the trustee might have accumulated some of the firm profit that ended up in its hands. Note that things like levies and offsets don't count, so you can't get any more than a 45% tax rate based on the current rates. You don't get the benefit of the 2% levy actually paid under these calculations. And likewise with the offsets, even though you might get a refund or a tax credit due to, say, a lower middle income tax offset, that reduction in your tax liability isn't counted for these purposes. So you might actually be seen to pay more tax than what's actually paid because of that offset. And lastly, note the concept of firm-related amounts or associated deductions, which is referenced in the PCG. And they provide an example there of interest incurred by an IPP in providing funds to a firm as being an example of an associated deduction. And the key point to note is that these reduce how much tax is considered paid, as you're required to work out the tax paid on the firm profit net of these deductions. Whereas unrelated deductions, let's say unrelated investments or business activities, don't reduce the tax paid, as you can effectively ignore them and work out tax paid as if those losses didn't exist. So associated deductions hurt the second risk factor, and unrelated deductions don't. Now for the third factor, I'll touch on just very briefly because Gavin already mentioned, and I think summarised it fairly well. Again, it's the commercial benchmark for the services provided by the IPP, and comparing what was actually returned in the IPP's hands versus that benchmark. And Gavin mentioned some ways you might go about this, and the PCG outlines, I think, up 11 factors when, let's say, comparing a senior employee's remuneration package to the IPP, who might have extra duties over and above the most senior employees, such as involvement in high-level management and business development and setting the strategic direction of the firm. So probably not an easy exercise, and the HCO recognises this, where in some cases you might only need to apply the first two factors. But if you can work it out, you should, and do work out your commercial benchmark remuneration. Should be consider all elements of remuneration when comparing to employees, including salary and fringe benefits, super contributions, and it should also be reviewed annually and documented appropriately. So with that commentary on the first three PCG factors, just go through some, I think, fairly basic case studies to demonstrate. Now, realistically, some of these case studies might involve, 5, 6, 7 entities once all the profit distributions flow through. So we wanted to keep it simple at the risk of overcomplicating things. So in the first example, we've got a basic case of the IPP is already a 45% rate tax paid. I've got enough other taxable income before any profit from the firm comes through. And we have a corporate beneficiary paying tax at 25% rate. So what we have here is $500,000 of total profit comes through from the firm to trusts controlled by the IPP. And the amount, those trusts distribute the income in a way that sees 50% returned in each, 50% in the IPP's hands, 50% to the corporate beneficiary. So what result does that get? If you do a basic 50-50 split, you get effectively 35% effective tax rate, which is the midway point between the top marginal tax rate and the corporate tax rate. So it sits exactly between 45% and 25%. And because 50% has been returned in the IPP's hands, you end up getting a score of 4 on the first factor, 3 on the second factor, 7 in total, and that's just in the green. Remembering 8 puts you in the amber. But just note that a $1 change in one direction or the other could get you into the amber. So 49.9% were distributed to the IPP, 50.1 to the corporate. You would get a 5 on the first risk factor because now you're returning less than 50%, and you still get a 3 on the second risk factor, but that would be an amber zone outcome. So that's just sort of demonstrating where the boundaries sort of are. What does a 50% split sort of get you? Bearing in mind, it's all very fact specific, because if the IPP, this example I have, other source of income, if there was no other taxable income, on this example, you might get something closer to a 29% effective tax rate when you calculate the IPP and the corporate beneficiaries' collective tax paid. And just note that when compared to the suspended guidelines, IPP would clearly be low risk under the suspended guidelines because they returned 50% and had an effective tax rate of well over 30%, both individually and collectively. So you can see how the updated guidelines might some cases shift practitioners into perhaps paying a bit more tax in order to get a low risk rating. In the next example, we'll just highlight through an example, the benefits available where the individuals who get profit shares have unrelated losses. So here we've got $600,000 of total profits coming out of the firm in the service trust, and it all goes to trust controlled by the IPP again, and it's split 2/3 and 1/3 between the IPP and his or her spouse. Now, we also assume that those two individuals, those spouses, jointly hold rental properties that generate $100,000 of negative gearing losses. So by being able to assume that by ignoring those losses, we can calculate tax paid by assuming taxable incomes were $400,000 and $200,000 respectively of those individuals, rather than actual taxable incomes, which were $300,000 and $100,000. So under that hypothetical assumption, we get an effective tax rate of over 35% and a risk score of 2 on the effective tax rate factor, the second factor, and that puts the IPP into the green zone, despite only actually collectively having paid $128,000 or so of income tax that year, which is about a 21% effective tax rate on the $600,000 total profit share. So that just demonstrates the benefit of being able to take the higher of, the hypothetical and the actual, where we have unrelated losses. Now, in this next example, we're just going to add a few more complexities by including things like fringe benefits and super contributions. So in the example, we've got $400,000 of profit share coming through to the IPP's trusts through the main practice and the service entity, or all the entities combined. So that's the profit share. But we've also got other forms of remuneration. So $70,000 of fringe benefits. Now, the PCG takes the approach that you use the grossed up taxable values of fringe benefits. So here, the actual values of fringe benefits provided were $33,000, $33,651. But the type 1 fringe benefits, you gross it up by a factor of just over 2. And it's taken to be that, well, $70,000 of remuneration was provided. Now we can count the 47% FBT paid on that grossed up $70,000 amount as counting towards the second factor. Now we also have here $130,000 of salary sacrifice super, which might seem above the normal contributions caps, but we've probably made a bit of it, put it together a more extreme example here where you can actually achieve that in a year without paying excess contributions tax, where you use the catch-up rule, where you haven't utilized, I think, the last 4 or 5 years of concessional contribution caps. So the key thing to note is that when you have a lot of profit share coming through as super contribution, they're taxed at a fairly low rate, 15%. So that's going to hurt an IPP on the second factor. So if we go back to we've got fringe benefits, we've got super contributions, and we've got this profit share. So the IPP has flexibility in how they distribute that 400,000. So let's say 300 is distributed to themselves and 100,000 to a corporate beneficiary paying tax at 25%. Now you find if you do that, you'll get total tax paid of just under $174,000, which is about a 29% effective tax rate. And you only count 50% of the total $600,000 package as being assessed in the IPP's hands. So you look at $300,000 profit over the total package of $600,000, not just $300,000 over the $400,000 profit share. So you get 50% rather than 75% on the first factor. So we're in an amber zone if we get this situation. We get a score of 8. Now, what can you do? Maybe you do some planning and you find you're in amber. What can you do to maybe move into the green? Now, you can shift either of the first 2 factors. You might look to get 60% plus in the IPP's hand, so distribute up to $360,000. So some to the IPP and away from the corporate beneficiary. Or you could try to get a lower score on the second factor, so to get up to a 30% effective tax rate. So to get a 30% effective tax rate, you need to get $180,000 total tax paid. So here we're about $6,000 short. And you can sort of deduce that at a 20% tax rate differential between the IPP and the corporate, you need to get about $30,000 more into the IPP's hands and out of the company's hands. And if you do that, you can distribute 330,040 to the IPP, the balance to the corporate, and you get just on that green zone by getting exactly 30% effective tax rate. So it might be just how you might think about this when doing year-end planning regarding distributions and wanting to achieve a low risk rating. Now, on the last example, we haven't really touched on here, but we want to demonstrate how the PCG suggests that this framework works for incorporated practices. So what the PCG says is that where you get franked dividends, you effectively take the grossed up pre-tax amount as a profit share. This essentially equates a corporate distribution to distributions of untaxed income flowing through a partnership or a trust. So in this example, we've got $600,000 of profit share coming through. That was paid out by an incorporated practice entity that paying tax at 30%. And that's comprised of $420,000 cash and $180,000 of franking credits. Now, this goes up to a family trust and that distributes, again, basic scenario, 50-50 to the IPP and a corporate beneficiary. So the key is to work out the total tax paid. You simply work out the taxable income of the beneficiaries who the amounts flow to, multiplied by the appropriate personal or corporate tax rate. And you ignore, the key point is you ignore the effect of the franking credit offset. So you only count the basic tax liability rather than any top-up tax. So what you'll find in this example, because here we've got a corporate beneficiary that pays tax at 25%, it will only be seen to have paid $75,000 on its $300,000 gross up profit share. It will have $15,000 of excess franking credits, which represent amounts of tax actually paid by the firm incorporated entity, but they do not count for this exercise. So even though the money has gone to the revenue, it's not recognized here, presumably because those credits could be used to shelter other taxable income by that corporate beneficiary in the current or future year. That could, for example, be converted into tax losses. But even if they're wasted and never used, that $15,000 extra corporate tax just doesn't count. So here you get into an amber zone because you get a 28.6 effective tax rate. And on the next slide, we'll just highlight if that distribution to the corporate is made to a 30% corporate, you won't have excess franking credits. And you can count that $15,000 extra tax as being paid because now that company has a 30% sort of headline rate, and you can count $90,000 of tax paid because you simply apply 30% to its $300,000 profit share, even though there's no top-up tax because it's fully franked. And in that case, if you count that extra 15,000, you get into a green zone because you get a total risk score of 7 under the first two factors. And I know in these I haven't taken into account the third factor, but as Gavin mentioned, that might need to come in if you can work out what your commercial benchmark is. So just to, after rounding out those examples, just touch on a few things that the risk assessment framework isn't super clear on. First is whether you look at tax or accounting figures. Now, I think the A2 is likely to have data on just tax amounts, but you could have some years where there could be large provisions or movements in WIP balances creating, skewed outcomes. And the PCG recognises this, and Gavin touched on it, that this is an extraordinary factor that could affect the risk rating, and you might want to document why you might get a higher risk because of these factors and engage with the ATO if appropriate. And that goes to these other areas of uncertainty where, again, we've got incorporated practices or even corporate beneficiaries getting profits, and there's a mismatch between the year the underlying profits were made and when those amounts flow through, because companies typically pay distributions after year end, maybe even just to shore up its franking account position. So again, the PCG can't be a perfect scientific tool that works at every possible scenario. So these are just some of the imperfections you should be mindful of. And the last one is losses flow where they're soaked up through at level of trust. So where there's individuals with losses or companies with losses, it's fairly easy to apply, but where distributions get soaked up along the way in lost trust, it's not exactly clear how you apply the losses, how you're seeing income to be taxed. You just assume that to the extent that the losses are used, that no tax has been paid, or can you sort of attribute those losses into the IPP's hands if the amounts flow through a lost trust to the IPP? Because you might be seeing as effectively using up deductions that would have saved tax at the IPP level. Again, it's not clear, but you might need to consider these factors because, again, it's not a perfect tool that takes into account every scenario. So what does this mean for upcoming year end and beyond? So again, we have a start date of 1 July 2022. So no change for this year end. And Gavin mentioned you've got a potential ability to rely on the suspended guidelines for another 2 years. So those with high risk features like fixed drop partners, they've sort of been put on notice as being high risk, and they might have to immediately consider their circumstances. And this could be a retention issue for many firms if they can't keep those arrangements in place for their salaried partners. So those that aren't a high risk might consider whether you can access the transitional rules, and whether you might give you more time to make any changes, which might involve structural changes. So for example, if you've got situations where there's been an ever assignment of 60% of a partner's interest to a spouse, that might be really difficult to get into a low risk zone if at least 60% of the income is already diverted away. So that might require structural change and might have a tax cost associated with it, but you could have some time to work through how to deal with that. Otherwise, you can start modeling outcomes and seeing where existing arrangements fall under the new guidelines and what impacts there are for things like asset protection and management of cash drawings going forward. Now, before wrapping up my end, I just want to quickly highlight that Pitcher Partners have developed an online calculator or toolkit that lets you plug in some numbers and quickly get a risk score based on this PCG. Again, noting can't cover every scenario, but hopefully we've covered most things that are contemplated. Now, we'll get this out to everyone in attendance probably in the next week or so. We're just having some final checks from IT, but we'll get that URL out to everyone and you can use it at your leisure once it's public. So with that, I'll pass back to Ben to go through some questions with Gavin to wrap up today's presentation.
Thanks, Leo and Gavin. We have a little bit of time left, Gavin, so I've got a few questions that have come through and a couple we had earlier that I hope you don't mind answering for us. The first one that comes up quite often in conversation with us with practices or practitioners is often a number of practices will feel that they've been unfairly treated by the ATO, being, I guess, singled out as a professional practitioner versus wholesalers of widgets or potentially professional practices that aren't specifically captured by the guidelines. Is there a strong legal founding or basis that the ATO have built this upon that would give comfort in our responses to why they're being treated separately in their view?
Yeah, well, the ATO has always had a sort of concern regarding the alienation of income from professionals and those who are using their specialised skills and being rewarded for the use of those skills and knowledge. So it's been a fairly consistent aspect. The ATO has had concerns. As I mentioned, it goes back to the Gallon case back in the sort of mid-70s, being concerns in there. And the court cases came out from that, and Phillips looking at service trusts as well. So we certainly acknowledge that there is an element of business-related income which is coming out of these professional firms, coming out to the IPPs, but we just want to make sure that the reward for their own personal efforts and skills are not being sent off to another area or another entity within their group purely for a taxation purpose.
So for those practitioners who therefore are willing to accept the guidelines and they want to sort of fit within the various categories, what we've found is sometimes as a challenge has been the reducing corporate tax rate or the changes to personal income tax rates that may be forecast in the future. Do you have any views or insights around where the guidelines are today and whether there may be changes or tinkering to those in the future as other peripheral tax matters change?
Well, the guidelines and the effective tax rate was never actually benchmarked to the corporate tax rate. It was simply said that a 30% tax rate would give us a level of comfort in terms of that there's very low or lower risk of there being an alienation of a professional firm, again, a professional partner who is deriving the income, sending that out to separate areas. So again, just that looking at the overall aspect. But as I mentioned earlier on, the PCG is intended to be a living document. It really is not a situation of us saying this is what Part 4A applies to or what a legal issue is. It's looking at how the ATO is going to be devoting our resources to looking at these areas of concern. So, if we determine that structures being put in place and those rates altering may mean that it's a lower risk for us, or the risk of the effective tax rate might be needed to be lowered. We're willing to look at that in the future as that sort of goes on. I wouldn't expect there to be any change in the near future, as we are seeking to sort of implement these changes, and particularly with many, I would say the majority of practitioners still able to access the suspended guidelines for the next 2 years. But we will in that period be looking at whether or not this risk rating gives us a reasonable aspect of looking at dealing with that risk with our resources.
And that probably then dovetails well in the next question, which was from one of the attendees, was subsequent to the guidelines being released, there's been a number of other either draft or taxpayer alerts, particularly focusing on trusts and the distributions to various beneficiaries, particularly adult children. Do you have any insights or views around how those taxpayer alerts and the use of other beneficiaries would interact with the PCG and either trump or play out in terms of how practices and practitioners would plan their affairs going forward?
Yeah, well, taxpayer alerts are sort of a way that we can identify specific areas of risk and specific areas that we are concerned around. The one that I think was mentioned in our sort of Q&A today was looking at the distributions from trust to adult children. Obviously, that's a very common situation of distributions from trust going to various family members. Now, that doesn't immediately mean that you are kicked out of being able to apply the PCG by simply just having another member of your family being distributed from the family trust that owns an equity interest in the professional firm. You'll need to look at the other factors that taxpayer alert is looking at and is of concern around. And that one being released earlier this year, so looking at 100A and some of those other factors. So, you know, while we say in the high risk features are things included within our taxpayer alerts, simply having one aspect of a taxpayer alert doesn't mean you're completely excluded from the PCG. You will need to consider further what is the risk and the concern that we are discussing within that taxpayer alert. And if you have got concerns or you have questions as to whether or not a taxpayer alert might be impacting your ability, you can contact us on that professional pdts@ato.gov.au.
Great. Well, thank you. Being conscious of time, we haven't had any other questions come through. I think we could find plenty of avenues to talk about this all day. But Beckham, very much we thank you for your time today to join us on this session. I'm sure all the attendees got a lot of value and context, leading into this 30 June and moving forward around the ATO's views and the requirements to monitor going forward. So thank you, and to all the attendees, thanks for attending today. The slides and recordings will shortly follow. And if you do have any questions, Gavin's mentioned there's the ATO email address, and also myself, Leo, and any of your contacts, regular contacts at Pitcher Partners would be happy to talk through any questions you have further. Thank you.